students, welcome to Adda 24/7. We are in the Shikhar series for BFM. All the subjects we are covering ABM, BFM, ABFM, BRBL. I am covering BFM as well as ABM. So in today's BFM topic, I will be covering risk management and risk framework basically. So this is module B, first topic of module B. So follow the video till the end. Like the video, share the video, okay? Subscribe to the channel without failure. Do that first, okay? So let's move on. Here, first I'll be covering the theory, then the numerical, objective questions. There are no numericals in this topic. So first theory and then the objective questions. First, you need to understand risk and then risk management. What is the risk? What is the risk? Okay, let me ask you one basic question, very basic question. If you put your money in the double scheme means what? You know these schemes nowadays? KBC scheme, there are many schemes which have come. Throughout India they are there. Some smaller schemes come. Ban jao Karodpati, ban jao Lakpati, ban jao this. If you put your money in that scheme in which the money gets doubled in 25 days. You have these schemes. Have you seen? How many of you have seen these schemes? 25 days money double. That Akshay Kumar movie, you know that, na? Akshay Kumar, Sunil Shetty and Paresh Rawal. Double, 27 दिन में double. So now you tell me, if you put your money, hard-earned money in that scheme, is there any risk involved in it? Is there any risk involved in it? If you put your money in any scheme like this, or suppose if somebody puts his money in some penny stock, very penny stock, constantly puts the money in penny stock. So is there any risk involved in it? Yes, you will say, yes sir, definitely. There is a risk of losing the money. I will say there is no risk involved. Why no risk involved? See here, if you put your money in such schemes, money double or something like this, you are sure to get, your money is sure to go down, right? Your money is sure to be exhausted, gone. You will be fooled by that person. Similarly, if you buy the penny stocks, once or twice you will get some money, but in the long run you will always be down. So kindly understand the meaning of risk. The meaning of risk is such that when you know certain thing is going to happen, then it's not called as a risk. Let me explain you again. If you put the money in that double scheme, 27-day double scheme, you are definitely to lose the money. Sure, you are sure about it. You all know you will lose the money. Then what is the risk involved in it? Will the insurance, here what is considered as the risk? When the insurance company this covers the risk, covers that element, then it's called as a risk. If insurance company is not covering it, it means it's not a risk. Means it's sure to die. Right? Is the insurance company covering the insurance of anyone who has got some disease, cancer or something? Will insurance company cover it? No. Why? Because they know that there is sure chance of this claim might come. So risk means what? To happen or not to happen. Anything. To be or not to be. Okay, that is risk. One more example I'll give you. If somebody goes on the 5th floor of a building, 5th floor, okay, and plans to jump from there. Of course, it's not a good example, but if somebody does, is there any risk involved in it? Now you answer me. There is no risk involved in it. Why? Because that person is sure to die. If somebody jumps from the 5th floor, that person is sure to die. Risk means to be or not to be, whether it will happen or whether it will not happen. If there is uncertainty, then only there's a risk. Means, for example, if you buy a good company share, let it be anything, means let's say Infosys, Reliance, HDFC Bank, SBI, good company share, then there is a risk that the share might go up or go down or maybe constant for some time. So then there is a risk. But if you buy some share of some company, anything which we don't know, many companies are there, penny stocks, just check this Z group stocks in the stock market, T group, Z group, many companies are there. If you buy those companies, you are sure to lose your money. So risk means to be or not to be. So that's why always play in a limited field. Reliance, HDFC Bank, SBI, PNB, all this limited field. They go somewhere up, somewhere down. See this, like this it is. Means these companies, they'll always go in the range generally. Year or year or year like this. So here it is covered. This part is covered in the risk. Insurance company will cover this. But if some company is like this, here goes over here, will insurance company cover this company? No, it will not. So kindly understand, risk means the thing may happen or may not happen. Only then it's called as a risk. Okay? Risk is uncertainties resulting in adverse outcome. Look at this, adverse outcome. Adverse in relation to the planned objective or expectations. Now what do you mean by this? Here. Suppose if some student studies a lot and expects 90% marks. Expects 90% marks. And if that student gets 95% marks, then is it a risk? No. Why? Because it is more than the expectation. Adverse outcome is required for risk. If that student gets expecting 90, that person gets, let's say, 80% or 85%, then there is a risk. So risk is uncertainties resulting in adverse outcome, adverse in relation to the planned objective or expectation. Okay? Planned objective or expectation. Got it, everyone? Now what is this? Is risk. What I had planned, it's not going as per that. I had planned to go to Delhi, but it's not going. Train is not there. So adverse outcome. Now similarly, financial risk. Financial risk are uncertainties resulting in adverse variation of profitability or outright losses. Adverse variation. You just now saw this guidance and profits of Infosys. Right now Infosys results are out some 2 days back. They have missed the target. Adverse variation in profitability. What the profit was expected, it didn't come. Hardly by 1 or 2 crores they have missed it. But then also missed it. So adverse variation in profitability or outright losses. Outright losses means what? Directly loss. These things happen in like present, let's say latest case. This California fires, LA, Los Angeles. Have you heard about this? How many of you have heard about Los Angeles fires? Just type in the comment section. What is the Los Angeles fires and what is happening in that? Anyone? In the comment section. LA fires. Just type on Google LA fires. Huge devastation, huge. And do you know? Insurance companies are not covering it. Not covering. They said we won't cover. They've already exited Los Angeles. They've already exited Los Angeles. My God. One of the best American cities, one of the best cities in the world. There's no insurance cover in that city. Where are we? Isn't it? We are far better in our country. So financial risk are uncertainties resulting in adverse variation of either profit will be lower or you'll have a loss, outright loss. What is the difference between uncertainty and risk? What is the difference between uncertainty and risk? Uncertainty is imprecise, vague, unclear knowledge about the future events. It may happen, may not happen. I don't know. India's GDP will be what? I don't know. 7.5, 9, 12, I don't know. Uncertainty. On the other hand, risk is that kind of uncertainty which can systematically be assessed through reasonably reliable probability distribution of outcomes and therefore measured and priced. Very fine differences there between uncertainty and risk. This question comes in exam. Very fine difference. Say this. Uncertainty means what? I don't know what will be the GDP of India in next 5 years, 10 years. I don't know. I can't even guess. Let's say I say it can be 7% also, it can be 12% also. I don't know. Uncertainty. But risk, understand the concept of risk. In risk, it is uncertainty only, but which can be measured. I can have some calculations for that. That's called as risk. When I can calculate, do some calculations, it's not just a case of luck or vagueness. Luck, here many of us say na, भगवान देगा तो देखेंगे. That is uncertainty. But अगर आप मेहनत करोगे तो भगवान तो देगा ही, है ना? Right? If you do your hard work, see 90% of the hard work is there and 10% is luck. But to get that 10% luck, you need to have 90% of the hard work. Similarly in risk also, uncertainty is there, but you can do some calculations on that. Now same example I'll take, GDP, India's GDP, will it be Bharat? I don't call it India now, Bharat. Bharat's GDP. Bharat's GDP is what? 10%, 12%, will it go? Now if I'm uncertain, I'll say vagueness, I don't know. But if I've done the calculations, what is going on in stand-up India, what is going on in startup India, what is going on in the economic output, what is the this government spending. If I have done the calculations, then I can't say with certainty, exactness that GDP will be 12%, but I can say around it will be 12 to 14%. Because I have done some probability distribution outcomes. Look at these words. Systematically assessed through reasonably reliable probability distribution of outcomes. Means I have done some calculations on it. And only on that I'm predicting something. So that is risk. Uncertainty is associated with the risk element impact the net cash flow of the business. Kindly note, cash flow is affected. Whenever you have risk, immediately say what was the basic premise or theme of this risk? Profits are lower or losses. Profits are lower means what? Your cash flow is reduced, right? Your cash flow will be reduced over here. Under the impact of uncertainties, variations in the net cash flow takes place. When we have uncertainty, net cash flow will be variable. Variable means what? Sometimes it might be high, sometimes it might be low. You don't know, you can't predict. But if you have done the calculations, somewhere you can predict. At least 70-80% you can be correct. This could be favorable as well as unfavorable. The possible unfavorable impact is the risk in the business. So whatever is the uncertainty, in uncertainty I can have a higher side also, I can have lower side also. Whenever I am having it at a lower side, then it's called as risk. If it's at the higher side, that's not a risk, isn't it? Now what do you mean by this? Low risk. Now understand the terms low risk. Low risk implies lower variability in the net cash flows with lower upper side and lower downside. What do you mean by this? I'm a low risk person. Means what? What do you mean by I'm a low risk person? It means that I'm very much comfortable in my zone. FD. I like FD very much. Bank FD. Invest in bank FD, get 6.57% and happy go. Low risk. Now, you can't condemn anyone or you can critique anyone. That's, yeah, what is this foolishness? 6.5%. It's not that. It depends on human beings' life stage. If somebody is 70%, 70 years old or 65 years old, why should that person invest in high this equity stocks? That person will invest in FD only. So you can't say, here, the one who is of the age of 25, 30, 35, 40 max or even 50, that person is free to invest in equities. So lower risk means what? Whenever somebody is having a planning for the lower risk, it means that person is having lower variability. That person doesn't like much fluctuations. So in net cash flows with the lower upside and lower downside. Higher risk means reverse. Higher upside, higher downside. Zero risk means no risk at all. Where is the zero risk? If I put my money in NSC, National Savings Certificates, no SIDB bonds, no risk, zero risk. Because after all it has a sovereign guarantee. Sovereign guarantee means government guarantee. It has got a sovereign guarantee. So if anything has got a sovereign guarantee, that is always having a zero risk. Sovereign means what? Backed by the government. What is sovereign guarantee? It's backed by the government. Okay. So zero risk means no risk. Low risk means FD of nationalized banks. Also, they can also be called as zero risk instruments. But then also, some part is there. Return on zero risk investment would be low as compared to the opportunities available in the market. Obviously, no? The one who invests, see, these are the three markets. Okay, I have shown it over here. Three markets: equity, debt, and liquid. When I invest in equity markets, the risk is highest. When I invest in debt market, risk is medium. When I invest in liquid market, risk is lowest. Equity means, for example, shares. I invest in stock market. Equity, highest risk. Debt market, bonds, FDs, low risk. Liquid, savings account, low risk. Or liquid bonds, treasury bills, T-bills, liquid. So you'll definitely get lower returns over here. The returns in liquid are around 4.5% max. Debt is around 7% max. Equity can be anything. Equity can be around 40% also. But risk is also higher. So the logic is very simple. High risk, high returns. Low risk, low returns. Isn't it? Linkage among the risk, capital and the return. What is the linkage? See, the whole business in this world, let it be any country, everything revolves around these three parts only. 3 points. What are these 3 points? Risk, capital and return. If I am expecting higher returns, I'll have to take higher risk. So capital required would be higher. Isn't it? Money required would be higher. So risk, capital and return are the trinities of risk management. Trinities. Shankar, Shambho, Trishul. Trishul of risk management. Right? Risk, capital and return. Minimum capital required for a business should be such that it is able to meet maximum loss that may arise from the business to avoid bankruptcy. So by investing in minimum amount, I should be able to cover maximum risk. That's what insurance is. What is insurance? By investing just a simple premium, small amount of premium, you are covering a huge asset, isn't it? Aren't you covering it? So minimum capital for business should be such that it should be able to meet the maximum loss that may arise from the business to avoid bankruptcy. Okay. So you had this principle in JIB also, conservatism. JIB account conservatism. You had this. Okay. So definitely remember the basic logic. Minimum investment, maximum loss cover. That is the logic of insurance and that is the logic of any business also. What is the relationship between these three then? Risk, capital and return. See this. It's over here. High cash variations. If I am having high cash variations in my business, means sometimes, what do you mean by high cash variations? 1 year I am getting the return of, let's say, 70%. Next year I am getting the return of, let's say, 20%. Again next year I am getting the return of, let's say, 90%. What is this variability? 70, 20, 90. Huge penny stock, Z group stock, T group stock, right? These are all penny stocks and huge variations. When you have huge variations, definitely you will face huge risk. If risk is huge, what will be the next step? See this. High risk business, high profit or loss, and high capital requirement. Because the fluctuation is huge, so capital requirement would be high. What is the example for this? Take simple example. If anything is more risky, the insurance premium for that is always higher, isn't it? So same logic over here. High risk, high capital. So high risk, high capital, high returns. Reverse is also true. Low cash variation. I'm having every business I'm having, let's say 1 year I'm having 70% returns. Next year I'm having 72% returns. Next year again 72, 73. So that is low variation. It's not changing that much. Like in retail banking. Retail banking doesn't change much. Every year it has a constant growth, right? So low cash variation. If you have low cash variation, it means you have lower risk. If you have a lower risk, it means what? You have lower profits. It means what? You have lower capital requirements, less premium for the insurance, right? Everything compare it with the premium of insurance. Whenever you feel, what do you mean by this capital? Immediately compare it with premium. Think, if something is very risky, what will be the premium? Higher or lower? Higher, so capital higher. Simple. If I put it in FD, bank FD, nationalized bank FD, is there any risk? Almost nil. Almost. I'm not saying completely nil, but almost nil. Okay. But if I put it in stock market, there's a chance. If I'm more in the stock market, if I put it in call and put options, option market or futures market, the risk is higher than the stocks, isn't it? So kindly note, there's a linkage between the risk, capital and return. More the risk, more is the return, more is the capital. Lower the risk, lower is the return, lower is the capital. Okay? Why risk needs to be managed? Why do we need to manage that risk? Management means what? It should be controlled. It's like the fire. What is risk? Risk is like the fire. If you control that fire, it is useful for you. It can cook your food, right? But if you don't control the fire, then LA fires, Los Angeles fires, California fires, isn't it? Same is thing with water. Water, if you control the water, it gives you life. But if you don't control the water, it will take your life, right? Same thing about finance. If you control your loans, they will help you to grow in life. But if you don't control your loans, they will kill you. You see many cases in the newspaper because of that credit card loans, heavy loans, that person suicide. Why? Couldn't control the loans. You have to control the loans. See, a loan is not a bad thing in life, but controlled loan is what is required. So risk management creates an imperative to develop methods to measure risk so that the organization is aware of the risk it is carrying for its business. So imperative to develop methods to measure the risk so that the organization is aware of the risk means what? Every company must know what is the risk in its business. Still, let's go deeper in this. What do I mean by this? Every company must know. It means, suppose if I am in the insurance business, insurance company, I must know what is my risk. If tomorrow all the claims come to me, like Los Angeles fires, LA fires, all the claims come to me that my house is gone, my house is gone, give me the money. The insurance company will go bankrupt. So, insurance company, kindly note, means I must be aware in banking tomorrow. If all the loans become NPA, my bank will go bankrupt. So, the point is like this. Every organization must be aware of the risk it is carrying in the business. It has a measure of its potential losses or severely adverse situations. Means if the situations are totally against, what can be the worst situation? We say in our life now, think of the best, be prepared for the worst. That's what we say in our life. Think of the best, be prepared for the worst. Same thing is with the companies. Adverse situations. And they may ensure capital availability for its continuous. Means capital should be there. Minimum capital, maximum coverage. Or limit its risk exposure to the extent of capital available. So minimum capital and maximum exposure. Overestimation of loss on account of risk may result in overpricing. What do you mean by this? Suppose if tomorrow I say, no, there are accidents on the road here, I don't take out my bike or car, accident might happen. Then what's the use? Why did you buy that car? Why did you buy that bike? Right? So overestimation of loss on account of risks may result in overpricing. Kindly note. Okay? Overpricing. Resulting in loss in the business. Loss of business means basically your business will be lost over here. You lose money. Why? Because if you put higher amount of, let's say in your this loan only, if you put a higher rate of interest, nobody will come to you for this loans. You lose the business. So overestimation is bad, and reverse is also true. Underestimation. I say that कुछ नहीं होता चलता है. They बांट दे लोन. दे कुछ नहीं होता अच्छा आदमी है. Underestimation, that is also bad. That will create means your losses, heavy losses in your business, right? And it will definitely affect your profits as well as planned REROC. Profits are affected. What is REROC? Risk adjusted return on capital. Risk adjusted return on capital. So that will definitely affect your REROC. How to define the REROC? See this. Firstly, understand what is ROC. So these terms are important. ROC. First, understand ROC. ROC means return on capital. ROC. Return on capital. Okay. What is RA then? RA. Risk adjusted. Risk adjusted. Okay. So full definition is risk adjusted return on capital. What do you mean by this? Let's say I'll give you a simple example. Suppose if you are using a car for your business. Let's say we have these in the car shops, right? On the roadside. Suppose if somebody is using car for his business, that person has purchased that car for, let's say, second hand for 2 lakh, 3 lakh, 4 lakh, 5 lakhs. That person has purchased the car for 5 lakhs. So this car is giving him returns. Why? Because he is doing business in that. Auto wala, car wala, right? Taxi wala. What are these? Right? So they have purchased this car or auto for the business. So they are getting return on this investment. But for that, they have to buy this insurance also. For that car, for that auto, everything. So this insurance purchase is known as risk adjustment. So that is the full definition. So suppose if I say, what is my return on capital? If I am getting 1000, let's say 1 lakh rupees per year from that auto or from that this car, and I'm paying the insurance premium of 10,000. So what is my net return then? 1 lakh minus 10,000. So adjusted return is always subtract the premium, insurance premium. Okay. Now let's see some questions. Let me, now I have spoken, now you have to speak. You have to give the answers. Internationally, a committee approach to risk management is being adopted. Which committee deals with different types of market risks? So internationally, committee approach, what is this committee? Asset Liability Management Committee, Credit Policy Committee, Liquidity Policy Committee, and Operations Management Committee. Committee approach to risk management is there. Which committee deals with different types of market risk? Look at this word, market risk. Who deals with market risk? Do you know who deals with market risk? Market. See here, there are 3 committees, kindly note. Okay. One is for market risk. Second is for credit risk. And third is for ops risk, operations. Okay. Credit risk is dealt by whom? Credit risk. CRMC they call it. CRMC. Credit Risk Management Committee. Ops risk is ORMC. So market risk will be what? MRMC? No. It's not MRMC. MRMC you might be saying, na? Market Risk Management Committee. No. It is called as ALCO. Asset Liability Management Committee. ALCO deals with market risk. Kindly note. ALCO deals with market risk. Got it? So committee approach, ALCO is dealing with market risk. Now which of the following is incorrect with respect to risk management committee? Incorrect. Huh? Now you want RMC, risk management committee. What is this RMC? Let me show you. If I'm having this slide, let me show you. Otherwise I'll draw it and show you. See this. In any company, the top is BOD, Board of Directors. They are the final authority required for the risk. Below them comes RMCB, Risk Management Committee to Board. This is to board. It helps the board in designing this all risks. Below that there are 3 committees. One is ALCO, CRMC, and ORMC. So these are the 3 committees, and this is the overall structure of risk management in any bank. Board of Directors, RMCB, ALCO, CRMC, ORMC, and below that there are support groups. Support groups. So these support groups will support these committees. Okay. Support groups. Okay. So which of the following statements is incorrect with respect to risk management? The purpose of top level committee is to empower one group with full responsibility of evaluating overall risk faced by the banks. You want incorrect one. Huh? One group means this, whichever group, RMCB. Okay. So after all, net from all the bank, complete risk is transferred to whom? It is transferred to this RMCB. It must consist of top executives who do not report to anyone. Do not. You want the incorrect one. Committee should hold the line management more accountable for the risks under their control and the performance of the bank in that area. So line management more accountable for the risks. So obviously line management is more accountable. What do you mean by line management? There are, see, board of directors is top management, top. Line management means over here, line, executive level. Okay. So obviously top management will hold line management responsible for any problems. Okay. So which is incorrect then? The incorrect one is this B, right? B. It is incorrect. B only. This is the answer. B only. Okay. This is the incorrect one. Which of the following activities are included in treasury management? Now this is again related to risk. Fund management, risk management, forex operations, profit maximization in money market. So which of the following are included in treasury? Fund management is there. Risk management is there. Forex operations there. Profit maximization there. 1, 2, 3, 4. All of them, isn't it? The broad parameters of risk management function should encompass. So broad parameters means broad guidelines. Broad guidelines of risk management should include what? Risk management policies that are consistent with the broader business strategies. So risk management policies that are consistent with the broader business policies. Broader business policies means, or strategies means, long-term planning. So a risk management should be in line with the long-term strategies. Guidelines and other parameters used to govern risk taking, including detailed structure of prudential limits. So guidelines and other parameters used to govern risk taking. It should include detailed structure of prudential. What is prudential limit? Prudential limit means given by RBI. RBI's limit. These guidelines are called as prudential guidelines. Comprehensive procedures and comprehensive risk reporting framework. So procedures and risk reporting framework. Okay. So all of them, isn't it? Risk management policies. You want what? Correct one, na? Yeah. Your risk management policies should be in line with the broader business policies. Your guidelines and other parameters should be in line with the RBI guidelines. Comprehensive procedures means detailed procedures should be undertaken. So answer is all A, B and C. Okay. Answer is all A, B and C. The major issue in establishing appropriate risk management organization structure is, what is the major issue? Means what have you to decide? Whenever I have to decide on this risk management structure, means which should be the committee, RMCB, which should be the committee, ALCO. What is the major problem? Choose between manual and IT oriented structure. Choose between centralized and decentralized structure. Choose between individual and decentralized structure. Choose between centralized and individual structure. Which is the major point which I should focus on? Think over it. Let me see the answer from your side. Many of you are answering this, manual and IT, but this is not the answer. Why? Because manual structure is not there in banks now. We are in the age of IT related banking. So manual system is out of question. So this is out. Right? Individual and decentralized. There is nothing called as individual the structure. Individual means dependent on one person. Can you have a bank which is dependent on one person, or any process in the bank dependent on one person? No. Out. Centralized and individual. Again, individual is there. Out. So the answer is only this. Centralized and decentralized structure. What is centralized? What is decentralized? Nowadays we are moving from centralized structure to decentralized structure. Decentralized means the power has gone in the hands of customers. So accordingly the powers will move at the lower level. Earlier, remember, you know that the loans were sanctioned directly from head office. Many of the banks, or at least the zonal offices, all loans, even the loan of 10 lakhs was sanctioned at the zonal office. Now the power up to 1 crore, 2 crore is given at the branch level, decentralized. So decentralized structure, we are moving towards that. So the major issue is establishing appropriate risk management organization is choosing between centralized and decentralized structure. Okay. These were the important questions which I wanted to point out and the important theory. Now before going, let me show you. Kindly join the Adda 24/7 classes immediately. Okay. Don't miss it. Why? Because here huge things are coming up at Adda 24/7. Huge things means paid batches. Plus you are getting some books also, means many things, many ebooks, test series, you are getting so many things. How to join the batches series? Go to Adda 24/7. Go to Adda 24/7. Always go through the app. In the app, you will be getting 1% extra using the coin systems. Okay. Go to Adda 24/7. Click on JIB and CIB. Look at this. Click on JIB and CIB. Click on CAIIB June 25. Say this bonus batch. Join this batch ASAP. ASAP. Okay. So join this batch fast. In this batch, just now it is starting. Okay. 24th Jan. Ebooks, mocks, online live classes, this best in class material. Okay. Latest pattern, compatible on all your devices. So you have everything. Click on buy now. Never forget the code Y432, Y432. Click on apply. 79% discount plus 1% extra, 80% through the app. So join this ASAP. Also you can join the Mahapack. In Mahapack, see this JIB, CIB Mahapack, or you can join CIB Mahapack. In Mahapack you are getting 15 plus batches per subject. So join this. Right now you are getting double validity. Means you buy for 6 months, you get for 12 months. Buy for 12 months, you get it for 24 months. And of course, that 79% off is there. Y432, never forget, Y432. 79% off plus 1% extra, 80% plus double validity. Don't miss this, okay? So join the batches as a batch is starting on 24th of this Jan, okay?